This is a masterclass on risk management and understanding the collar strategy that was famously used by many portfolio managers, traders, and investors, as well as myself. Today, we're diving deep into the world of investing to explore why options are safer choices compared to traditional stock investments with facts, figures, and charts. Whether you're a seasoned investor or just starting out, this video is going to show you something unique and new for managing option trading and risk management, which will make a significant difference in your portfolio's performance so you can make a lot more money in option trading. So let's jump right into it. Let's start by setting up our graph. On the horizontal axis, we have risk, which increases from left to right. On the vertical axis, we have return, increasing from bottom to top. We'll plot two lines, one representing a stock investment and the other representing the collar strategy. First, let's look at the risk-return profile of a stock investment. As you can see, the curve slopes upward, indicating as risk increases, potential returns also increase. This follows the traditional risk-return relationship of stock investments. The higher the risk, the higher the return. Basic Finance 101. Now, let's overlay this risk-return profile of a collar strategy. Notice how it starts lower on the risk axis compared to the stock investment line. This indicates that the collar strategy inherently carries lower risk. Additionally, observe the flatter slope of the collar strategy line. This signifies the limited risk exposure of the collar strategy compared to the potential unlimited risk of a pure stock investment. One of the key benefits of the collar strategy is its ability to limit both upside and downside risk. Unlike traditional stock investments where losses can potentially exceed the initial investment, the collar strategy provides a predefined range of risk exposure, offering investors a level of predictability and control over their portfolio's performance. The collar strategy is effective for smoothing out volatility primarily because it provides a structured approach to managing risk and controlling the potential impact of a market fluctuation on your investment portfolio. This strategy is very similar to a covered call strategy, and here's why this strategy is so beneficial for smoothing out volatility. The first thing is it has a defined risk exposure. The collar strategy allows investors to define and limit their risk exposure through the combination of protective puts and covered calls. By purchasing protective puts, investors establish a floor for potential losses. This defined downside protection helps to cushion the impact of a sudden market downturn, thereby smoothing out the volatility of investment returns. Number two, the collar strategy involves selling covered calls, which generates income in the form of option premiums. When you sell a call option, you are collecting premium upfront and that cash enters your account. This income component can help offset potential losses from market volatility, providing a buffer against short-term fluctuations in asset prices. Now, this is something I love to do because it's very similar to what Warren Buffett talks about, creating a margin of safety. Now, if you don't know exactly what price to pick a stock, a covered call actually gives you a cushion because you get to collect premium and then you get to buy the stock cheaper than it is today if you factor in the premium. So you don't have to be a stock picking genius. By selling covered calls, you already get a better price than the stock market itself. By consistently generating income through covered calls, investors can smooth out the overall volatility of their investment returns and achieve more stable, predictable cash flow. Not only do you cash flow, you also have a greater margin of safety and cushion on the downside. And the next thing is a balanced risk-return profile. The collar strategy offers a balanced risk-return profile by simultaneously limiting both upside and downside risk. While the strategy may sacrifice some potential upside compared to pure stock investments, it provides a level of downside protection that helps to stabilize overall portfolio performance. This balanced approach helps investors navigate periods of heightened market volatility with greater confidence, knowing that the risk exposure is very well managed. For example, if a stock ends up pulling back 10-15%, you will be safe and you may only see a 5% drop. Now, on the upside, if the stock goes up 5%, you actually may make 7%, so you may make more. The only case where you don't make more is if the stock really goes up a ginormous amount, such as like an Nvidia, something that just goes up 30-40% per month. Then in that case, it's going to be much better to just buy options or just hold the stock. However, I love this strategy because I have a higher return and lower risk in my portfolio long term. This strategy is very adaptable to market conditions, and if you've known anything about the markets lately, when you see volatility, being adaptable is the most important thing that you can do. The collar strategy is highly adaptable to changing market conditions, making it particularly well suited for smoothing out volatility. Investors can adjust the parameters of the collar strategy as they wish, and I'm going to go over an example very shortly. You can do different strike prices, you can have different expiration dates to align with the risk tolerance that you want to take and your market outlook. So I'm teaching you how to do this yourself. By the way, if you want to see me live trade all of my signals and be part of an amazing community, you can schedule a call by clicking the first link in the description and seeing if there's any spots in my calendar. Now, when it comes to adaptability, you always want to continuously monitor and adjust a strategy in response to evolving market dynamics. Investors can effectively smooth out volatility and maintain a more consistent investment experience over time by selling both covered calls and by buying some options in a way to mimic the caller strategy in different ways with different expiration days. Before I go over an example, I want to also talk about the diversification benefits, because incorporating a strategy like this is going to diversify your investment portfolio and can further enhance the ability to smooth out volatility while still having market exposure. By diversifying across different asset classes, for example, when I'm investing, I'm going for airlines, I'm going for technology, I'm going for some healthcare, I'm going for some consumer discretionary, I'm going, for example, that's Starbucks, that's Nike. I'm diversifying amongst different sectors and stocks, but I'm also diversifying amongst different strategies, because having multiple strategies in your portfolio will at the end of the day perform the best. So investors looking to reduce the overall volatility of their portfolio and minimize the impact of adverse market movements, which happen, from time to time. We can get a correction any day. The caller strategy complements diversification efforts by providing targeted risk management within specific segments of your portfolio. So you may only decide to put in 5, 6, or 7% of your money in this strategy. However, this is going to provide an enormously good benefit for your portfolio overall. Imagine you're an investor with a diverse stock portfolio, but you're worried about the overall market volatility impacting your investments. To manage this risk, you decide to allocate a portion of your portfolio to bonds or other fixed income securities. Now guys, I don't really cover bonds or fixed income on this channel because it's just too boring. I've been able to make hundreds of thousands of dollars per year trading options, and I don't go for any low return investments because for me, option trading is much lower risk and higher return than any other investment. So by diversifying your investment portfolio into assets that have lower volatility, it actually reduces your income stream. Instead, I prefer to be 100% invested in options, but manage my options properly with different strategies and pay really close attention to my risk exposure of my portfolio overall and protect against potential downside markets. So what impact do options really have on risk management? As mentioned earlier, one of the most notable features of options is their limited risk exposure. When you buy an option, the most you can lose is the premium you paid for the option contract. This contrasts with investing directly in stocks, because when you invest directly in stocks, you can basically lose all of the money that you put in. However, buying stocks is much more expensive than just buying a simple option. But starting with the first example, I want to explain to you the caller strategy and how it works specifically. So this involves combining the purchase of protective puts with the sale of covered calls. The caller strategy limits both upside and downside risk by providing a balanced approach to risk management while potentially enhancing returns. Now, just so you know, a regular covered call is probably going to perform better than the caller strategy in an up market, but in a sideways market or a volatile market, the caller strategy is going to be better. By the way, I'm happy to make a separate video on protective puts or covered calls. All I want to see is 1,000 subscribers on this video. Make sure you hit that subscribe button for me. So Mark Cuban actually implemented the caller strategy when he sold broadcast.com to Yahoo on April 1st, 1999 for $5.7 billion. Now I learned this when I was working at Goldman Sachs and I was talking to one of the advisors, and I learned that basically Mark Cuban used the caller strategy because he couldn't sell his stock. He had a large stock exposure. Now many of you guys don't understand how to manage your risk, so sometimes you have a big stock exposure, but you don't know what to do. Mark Cuban had a very large single stock exposure, so he needed income and he also wanted safety, and he didn't want to have $5.7 billion of his net worth in the stock solely, but he also couldn't sell it. So what he did was instead he used it to protect his gains. So the first component is a protective put. So this component right here of the caller strategy is purchasing a put option. A protective put is a type of option contract that gives the holder the right to sell a specific quantity of a security, like a stock, at a predetermined price. So let's say that you have a stock that's at 100 per share and you really don't want to own the stock, or you want to get out of the stock if it goes below 50. By purchasing a protective put, an investor can protect their portfolio against downside risk and any potential losses because they're guaranteed to be able to get out of the stock at 150. Now, because this does cost some money, you compensate for this and you actually collect income by selling a covered call, which is a call option. The second component of the caller strategy involves selling a covered call. The covered call is an option strategy basically where an investor holds a long-term position. Say you're holding a lot of Apple or a lot of Google or Tesla, whatever stock that you have, you can sell a covered call option and that will give you income. All right, so let's go over an example. My portfolio is back above $2 million. It's been a very good past couple of months. So let's go to Tesla stock. Let's say that you have a lot of Tesla, and Tesla has been pretty volatile. It has actually fallen down quite a bit. I'm actually up on Tesla because I'm just doing put credit spreads, but that's, a different topic than this video. So look, let's say you have a lot of Tesla. You're afraid that it might pull lower. So what you would do is you would go to trade Tesla options, doesn't matter which brokerage you're using. And the first thing is you would buy a protective put. So you would buy a put option. Let's say that we're going to buy a put option for the short term. Let's just say in the short term, you're pretty concerned if the stock goes, a lot lower. So let's say we pick a future date. Doesn't matter if you're watching this in the future. Let's say that we just want to protect ourselves for the next 60 days or so. Okay. So if we want to protect ourselves for the next 60 days, what we would do is we would pick a strike price that's not too far from the current price of the stock. So Tesla's at 176. Let's say that we're going to pick something like the 170. Okay. So we are afraid if Tesla goes below 170, the delta here is 0.38. So there is a, significant chance that this could happen. Not super significant, but 38% chance. The volume is pretty good at 793, and there's a lot of open interest. So a lot of people are trading this option contract right here. So what you would do here is you would buy a put option. Now, in addition to this, you would also sell a covered call. Okay, so you can sell a covered call a lot further in terms of days, because let's just say you're really happy and you want to lock in your gains, and you can play around with the expiration days. I'll show you what that looks like in just a moment. But let's say you're pretty happy and you want to just lock in your gains. If it goes up to 190, cool, but if it goes above that, you don't really care. You just want to make sure to kind of guarantee yourself that it's going to be in a very stable position and that you're not going to lose much money while still creating some income. So I would go to sell call option, and then you can just go for the 190 right here. If I expand this, the chances here are actually pretty high because there's a little bit more time here. So, because there's more time, there's a more likely chance, and that's why the delta here is higher. The volume is actually pretty low, which is typically not a good sign. So with the volumes low, you want to check out the bid-ask spread, because look, a lot of people don't understand this, but even if your brokerage is free, let's say you're using Robinhood or whatever brokerage, there's still a cost, okay? So when you're trading the bid and ask spread, let's say you're going to sell this option, well, you're not going to get 1740 for it. I'll tell you that right now. You're going to get something in between. You're probably going to get 1730. That's not that bad, right? It's usually the mid price, right? The mid price is usually what you get executed for. But if you think about it, you're not getting 1740, you're going to get 1730, so you're losing $10. So that's why it's important to have a tight bid-ask spread. And the tighter this is, the better. And 20 is not that bad, all right? So you go to sell call. Now here you can see that this position doesn't look that good, and that's because I'm not able to fully create the position on Robinhood with owning the stock. The missing component here is you want to own equal amount of stock for each option contract. So here we have one put option, one call option. We would want 100 shares. Okay, now having 100 shares would mean that you're actually collecting 1720 and you're protecting yourself with just, 1,045. So you actually get a net credit of $675. So you're making $675, you have downside protection, and you have income. That is the best of all worlds. Managing the collar strategy effectively involves monitoring and adjusting the components of the strategy to adapt to changing market conditions and investment objectives. So for example, let's say that Tesla goes up a lot and you no longer feel okay with selling it at 190. Let's say you become very bullish. What you can then do, for example, you would get rid of the 190 and you would roll it higher. So all that means is, let me show you with an existing position that I have right now in my portfolio. My portfolio is doing actually really good. I have a bunch of wins right now, except for Target, but this is a covered call. So I'm not really losing on this since I'm up a lot in the stock. Let me show you a roll. So let's say I have this Apple covered call right here. All right, so let's pretend that this is like Tesla, right? So if Tesla, and it's about the same price, which is cool as well. Let's say that Tesla goes up to like 182, or Apple, right, in this example, and you don't want to get rid of the stock at 182.5. What you would do is you would simply roll this position. Now, I love rolling because when you roll, you can adjust the position. You can either save money, you can make more money, and you can change your strike price. So here, let's say that Apple went up to 182.5, I can just simply go to roll this position, all right, and then I would change it to a future date. So instead of the current expiration, which is basically really, really soon for as I'm making this video, you would go to a future expiration. So let's say, typically for me, I like to run something that I call, in my Discord community, I call it the dog strategy. It typically roll by 30 days. So I'm going to move this out by 30 days. Now you will notice that I'll actually get paid to move this by 30 days. So as you can see here, I can easily move an option from 182.5 to 185. So I'm going to move up by $2.50, which is really good. That's quite a lot, right? I mean, just one contract, that's $250, but I have many contracts here. So what this means is when I'm moving an option contract from 182.5 to 185, I'm moving it up, which gives me more upside, which is amazing. And here you can also see the net credit here is 92 cents, okay? That's because this option is worth more. So the new option I'm rolling to, because it's worth more, I'm actually getting paid to roll. I'm actually making money to move up this option. That's exactly how you want to manage a position. You want to slowly manage it. Like I'm not going to go from 182.5. Here's the downside, okay? And this is not really a downside, but let's say the stock moves from 177 to something huge, right? To like 200, okay? If it goes to 200, then obviously I'm not going to be able to roll this for a reasonable amount. You can see here, there is a debit. So you don't want to run this strategy on a crazy stock But at the same time, if you run the collar strategy on a crazy stock, you still get the benefits that I mentioned in the video. In the beginning, I mentioned how you smooth out volatility. So yes, in theory, you will have to pay a debit when you roll, but in all, it is a really good strategy. You can still always roll by a little bit. So you don't have to roll from like, a huge amount. For me, I like to roll by 2.5, 5, maybe 10. So for example, if I go to 192.5, you can see that I'm basically breaking even here. I can move by a whole $10. This is a whole lot of money. $10 times, each option is 100 shares. That's $1,000, okay? Here, that's 68 contracts. That's $68,000. So it is a really big difference here, and I'm only paying $272. So you can basically move options quite a lot without having to pay a huge cost. Now, you also want to establish clear directions and objectives when you're running the strategy, because before implementing the collar strategy, you need to define your investment objective. Do you want growth? Do you want more risk tolerance? And what is your time horizon? For me, I run this strategy anywhere from 30 to 90 days. I don't really like short-term trading as it is costly, not really time effective, and going longer term gives me a clear direction. So you want to determine whether your primary goal is capital preservation, income generation, or a combination of both. For me, the collar strategy is used when the market is hot. We see that in the technology sector all the time. I'm really happy to be a technology analyst when I was working at Goldman Sachs, as well as other jobs on Wall Street. I like technology because it has high volatility, it has high growth, and there's a lot of money to be made in the tech space. We have seen that over and over again. So when you're selecting the underlying asset, right, which stock you're going to go for, choose the underlying asset or the assets for the collar strategy that do have some volatility, because the whole point of this strategy is you are against risk, okay? You're hedging, diversifying your portfolio. You can even do this with ETFs, and ETFs don't have a whole lot of risk, but still you can protect yourself on the downside. And I usually look for, when I'm doing the collar, on a stock that has a huge run up, because I'm not sure if the stock's going to keep running up. So I want to have some more gains, but I also want to protect my downside, because there is a lot of stocks that could shift momentum, and when they do shift momentum, then you get a really adverse move. So for example, if I go to Nvidia, we have seen, Nvidia is just a rocket ship upwards, but when it does pull back in the short term, it could be a little bit scary because you might have a lot of money in it. For example, let's say you had 900 in Nvidia. Well, if it goes down and just from March 8th, for example, here, just 3 days, you went from 950K to 850K. So you can lose 100 grand really short term. Although this doesn't look bad, trust me, it's going to make you feel bad. And that's one of my biggest things in my coaching is I always want to make sure that people are not feeling bad and making emotional decisions. Because when you're making an emotional decision, that's not good. You end up losing money. And I'm actually making money right now in Nvidia. I'm just doing simple call credit spread strategies. That's because, sometimes I do focus on generating alpha with a small amount of capital or just growing a small portfolio. Now, for purchasing a protective put, you want to buy protective puts to hedge against the downside risk. So the strike price and expiration date of the protective put should align with your risk tolerance level. So let's say that we're going to look at Nvidia here. Let's say that it was right here, and we have seen that for not even that long, for multiple hours, it was stuck at 918, had a huge jump up from 918 level to 950. Let's say you just want to protect yourself and create kind of like a stop loss order. Basically, you want to protect yourself. If it goes below 918, you can buy a 915 protective put. And in this case, if you had done that, you would have actually done very, very well. Maybe you would have still lost money, but you would have done very well versus a traditional stock investor who's just holding the stock. You would have saved yourself a lot of money because, a traditional stock investor here at 950, as it went down, they would have lost like 100K. But here, let's just go over an example. I go to trade Nvidia options. Let's say that I wanted to do a covered call. Let's say that, just for example purposes, we go out, we don't even need to go out that far. Let's go even shorter term. I'll show you how much you can make in just 2 weeks, essentially 2 weeks. So let's say that you ended up selling a covered call. Let's say it was at, even if you went higher, you gave yourself a lot of upside space. You were like, hey, I think it's going to go up quite a bit. So if you ended up selling the 970, for example, okay, a little bit longer term than 970, in the short term, you were like, hey, I'm really afraid if the stock goes too low, I want to buy myself a protective put. And I said about 915. Now that 915 is going to be, here the stock is a bit lower, so it's not at 950. So this is slightly, not an exact perfect example. So let's just go for 9 here. If you were to do this, it's going to be a little bit expensive. Actually, buying the protective put is going to cost you a net debit. So you're actually going to spend $870. But the thing is, you get out of the stock at 900. So whenever the stock pulled back, right? So here, your break even $900 and you're paying $8. Here, when the stock pulled down to 850, okay, you essentially got out of the stock for 900, all right? So when it went to 850, you got out at 900. Yes, you paid $8 for it. Sure, you paid $8. So, your break even was $8.90, it's at $8.50. So you actually saved yourself $40. I mean, an investor lost a whole 100. You lost a bit less, right? Because at 900 you got out, so you saved yourself $50, but you paid about $8 for it, okay? So you saved $50, you paid $8 to save $50. So basically you saved $42, about $40. So it's a lot of savings that you can have with the protective put strategy and with collar strategy. Now the sell covered call part is very easy. You just sell covered call options on the same underlying asset to just generate income. You can go 30 days, 60 days, or 90 days. I do like to look at a delta of, about 30, and this also helps to pay for the protective put option. I'm all about the safe passive income. So for me, I'm going for safe deltas, 30 delta on the protective put. I might even go higher because the point of the collar strategy is to, basically protect yourself against downside risk. And I'm never looking for like high risk, high return home runs. Instead, I'm looking for, the safe, passive, consistent income. Therefore, I like the protective put strategy, the protective collar strategy, because it's neutral in terms of spending money. It's possible and actually very easy to even collect a credit when placing this trade. But on a net basis, you may collect some money sometimes, you may actually spend a debit sometimes. It really depends on your view. Overall though, the volatility reduction is well worth it even if you break even. Now look, you should also periodically rebalance the collar strategy to ensure that it remains aligned with your investment goals and risk tolerance. So if the stock runs up a lot, you're gonna need to adjust your covered call by rolling it. I do have a video on rolling, I'll leave in the description. Now for the selling put, you'll also wanna rebalance and potentially change the strike price. You want to stay informed about the market's developments, economic trends, geopolitical events, or whatever really is affecting the stock that you're holding. You want to obviously pay attention to that, but not too much attention, because if you overdo it and you overtrade, you're actually going to get worse results. Or simply look at the technical indicators like the ones that I teach on this channel if you're subscribed to my technical analysis playlist, and notice patterns and just adjust for those patterns. If the RSI gets really high, for example, you can end up selling a more aggressive covered call because there's an expectation the stock is going to pull back. A lot of adjusting just based on intuition, which requires continuous learning and pattern recognition. So take your time with this strategy.